Variance analysis is a key component of standard costing and performance management within the program framework. Standard costing establishes predetermined expectations for resource consumption and costs, while variance analysis compares these standards with actual results. The difference between standard and actual performance is known as a variance. Variance analysis helps managers identify areas where operations differ from plan and investigate the causes of those differences. By examining variances systematically, organizations can improve cost control, enhance operational efficiency, support decision-making, and strengthen accountability. Variance analysis therefore serves as an important management tool for planning, monitoring, and continuous performance improvement. Price and rate variances focus on the cost paid for inputs compared with the standard cost expected. A material price variance arises when the actual price paid for materials differs from the standard price established during budgeting. Similarly, a labor rate variance occurs when the actual wage rate paid differs from the planned labor rate. Favorable variances occur when actual costs are lower than standards, while unfavorable variances occur when actual costs exceed expectations. These variances help management evaluate purchasing effectiveness, supplier performance, labor market conditions, wage negotiations, and procurement decisions. Understanding price and rate variances improves cost management and budgeting accuracy. Usage and efficiency variances examine the quantity of resources consumed rather than the prices paid. A material usage variance measures whether more or fewer materials were used than the standard quantity allowed for actual production. Likewise, a labor efficiency variance evaluates whether employees used more or fewer labor hours than expected. These variances provide insight into operational effectiveness and resource utilization. Favorable results indicate efficient use of resources, while unfavorable variances may signal waste, poor quality materials, inadequate training, machine breakdowns, production bottlenecks, or ineffective supervision. Managers use these measures to identify opportunities for process improvement and productivity enhancement. Variance analysis is not limited to materials and labor. Organizations also examine variable overhead variances, fixed overhead variances, and sales variances to gain a comprehensive understanding of performance. Variable overhead variances assess differences in spending and efficiency, while fixed overhead variances evaluate budget adherence and capacity utilization. Sales price and sales volume variances measure differences between actual and expected revenues. Together, these analyses provide managers with a broad perspective on operational and financial performance. By integrating multiple variance categories, management accountants can identify patterns, assess organizational effectiveness, and support strategic and operational decision-making across the business. The interpretation of variances is often more important than the numerical calculations themselves. A favorable variance is not automatically beneficial, nor is an unfavorable variance necessarily problematic. For example, purchasing cheaper materials may generate a favorable price variance but could lead to poor quality output and an unfavorable usage variance. Similarly, labor efficiency improvements may result from increased pressure on employees, potentially affecting quality or morale. Effective interpretation therefore requires managers to investigate underlying causes rather than focus solely on variance amounts. Understanding operational context helps ensure that corrective actions address root causes rather than symptoms of performance issues. In conclusion, price and rate variances, usage and efficiency variances, and variance interpretation are central elements of standard costing and management control systems. Price and rate variances assess whether resources were acquired at expected costs, while usage and efficiency variances evaluate how effectively those resources were utilized. Together, they provide valuable information about operational performance, cost management, and organizational effectiveness. However, successful variance analysis depends not only on accurate calculations but also on thoughtful interpretation and investigation. By identifying causes, evaluating implications, and implementing corrective actions, management accountants help organizations improve efficiency, control costs, and achieve strategic objectives.